Good morning. Welcome to Rooster Reacts. We're just going to look at the most recent Fed rate cut and tell you what it means to you and for you.
Let's go.
Good afternoon.
Good afternoon.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
All right, and we can pause it right there. All right, so what really this whole meeting is going to be essentially nothingness except for the big thing that happened, which was they cut interest rates by 50 basis points, which is just 0.5%, and which is on chart 1. We'll show you what that is. And so really all this is the black line is the interest rate by the Fed. Okay, they cut it from 5.5% to 5%, and really all that means is, and why everybody reacts is that also signals that for other interest rates like credit card rates, mortgage rates, all those rates also are likely to come down. Okay?
Yeah.
So that's really all that happened. Now the interesting thing I find here is I don't think he's changed. Like, that statement sounds the same since
it sounds the same
every single time. I almost fall asleep during it because it's like, what? Like, are you actually saying anything? Like, is he awake for it too? But really, the big thing I'm seeing is he's saying we have stable prices. Okay, the economy is strong. Labor, it cooled from overheated, which really all that means is labor is down a little bit, so it's not. A little bit more unemployed people. That's really all it's saying, but nothing crazy. And then he says inflation's down on a year-over-year basis, but still very high historically. Like 2.5% is where it currently is. So essentially, you're like, okay, you have stable prices and a strong economy, and labor's fine. So the question becomes, why are you doing anything?
Right. If the economy is so great, what's with a 50 basis point cut?
Right, which is a significant cut for everybody to know. Like 50 basis points, usually maybe 25 basis points is a little bit normal. 50 basis points is significant, but it's very just counterintuitive of like, why would you do that? And also they want to return inflation to 2%.
Yeah.
Okay, sure. But
he says that.
Right, he says that, right? But when you cut rates, inflation naturally goes back up.
Yeah.
And so if you're at 2.5% right now, and
how's it going to get to 2?
And you're going to cut, how are you going to get back towards 2?
Right.
The natural thing that's going to happen is it's going to go back up further. So like if you want inflation to actually be at 2%, the normal thing you would probably do is wait for the headline inflation number to be like 1.8,
right,
1.7,
right,
2.0. It's not there.
No.
So it's like, yeah, I don't know. It's mind-boggling to me.
Yeah, it's a little bit counterintuitive, but we'll see, I guess.
Yeah, and we're going to go through a whole lot about what's actually going to happen to like asset prices, a lot more on this.
Yeah.
But first, we're going to keep with the Fed meeting. We're just going to skip a huge part of it. We're going to skip towards minute.
It's boring. You're missing nothing. Trust
me. He says the same exact thing
every time,
and it puts you to sleep. So we'll try to skip to 6.09.
In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025.
All right. And so that's really the most important thing that came out of this. They're basically saying the first rate cut, just so everybody knows, it's never the last rate cut. So when they're cutting by 50 basis points, really what they're signaling is we're probably going to cut again and again and again.
Starts the cycle, yeah.
It starts this cycle of cutting rates, okay? And so if you just go back to that chart 1, all he's saying is that 5% by the end of the year, so 2024 is the current year, that's going to be about 4.4%. So that's basically another 2 rate cuts, 225 basis point rate cuts, okay? And then by the end of 2025, that number is going to be all the way down towards 3.4. So that's an additional 6 rate cuts by 2025.
Yeah.
So essentially, all that's being said and was said in this meeting is it was cut by 50 basis points, and we're going to bring it down more after that.
Yeah.
Okay. Again, that's going to be inflationary.
Yeah.
Just so everybody's aware, that's the most important thing that happened. And now we're just going to skip all the way towards it's minute 31:19. This one's a little bit less about her actual question and a lot more about what his response is to this question.
Right.
And it's gonna be good.
I think I know which question.
That would be
I'm
impressive.
Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level.
Okay, we can stop there.
Yeah.
So did you see what you just said?
Yeah. The American economy is great. We want to keep it there.
Right. So everything is actually perfectly fine. We're not actually cutting because there's anything wrong. Because typically why they would cut is they see a recession coming.
Right.
And they're like, okay, recession's coming, and we don't want a really bad recession. So we're going to ease a little bit to make it so this recession isn't that bad.
Because it'll boost economic activity.
Boost economic activity is the idea, and make things so that you don't get into essentially depression. That's kind of the general idea. Whether or not you should do that, totally different conversation. But that's the idea. But what he's saying here is, we actually just cut, but everything's fine. We're actually we're
don't
good.
worry about it. Yeah.
Literally, don't worry about it. So the question becomes, why are you cutting? Why?
Yeah.
It's an unbelievable question, and we'll just continue after this because he keeps going.
The economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been
with
the
rates where
purpose
they
of which
are.
has been to get inflation under control.
To maintain it, you just don't do it.
We're going to move those down over time to a more normal level over time.
Okay. Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time.
We're close, but we're not there.
But, we're certainly not we're not saying mission accomplished or anything like that.
Okay,
but
so let's
I have
stop.
to say that.
But then what? Once it goes down there, then what? What do you already cut?
Right, you already cut.
So
and you're going to continue to cut further.
Right. So what's going to happen to inflation? It's going to go up.
It's going to go up naturally.
So that is it's actually declaring a loss.
It's
It's like the new norm is now just higher inflation.
Pretty much is what, or they I honestly, they did put in their projections for inflation, and they have their projections are for inflation to go down.
Yeah,
but
sure.
but like it's almost like, but that's you're cutting, therefore it's not gonna happen.
Right.
Like, and so it makes absolutely no sense. Like, if you haven't made victory, then why are you reversing your current course? Why not wait until you have victory?
Right.
Right. So let's just. Yeah.
He's just scared. He just doesn't want to be late. You know, he doesn't want to be too late.
I think he's getting paid by not paid, but like he has some
influence.
Some influence by Wall Street.
I'm sure.
So let's just go to the next slide, slide 2. This is why the Fed cannot be trusted on inflation, everybody. So let's just remind everybody what happened in 2021, okay? 2021, basically it's right after the pandemic, and everybody is printing money out of their tails, okay?
Yeah.
What was the Fed telling you about inflation? They were telling you it was transitory, which basically meant inflation, yeah, it's going up very fast, but like, don't worry, everybody, it's going to come back down
it's just temporary.
Very soon. It's just temporary, is what they're saying. And so I just put I just searched the word transitory because that was the word they were using. That was a little keyword. I put that into some Google Trends, and you can watch when transitory was trending. Okay, so when did transitory start trending? It was basically around 3/31/2021 when inflation was 2.6%.
Right.
We're currently at inflation 2.5%.
Right.
Okay. 2.6%, they're saying, don't worry, guys, it's transitory. Inflation now jumps up towards 5.4%, getting close to essentially some highs of like '08 and all these other time periods. Inflation is even more transitory than it was at 2.6%. Now we're like, okay, let's wake up, everybody. Inflation's now 7%. And at the end of 2021, transitory is trending even more.
Yeah.
It's even more transitory than it was at 2.6%. So while inflation is going up in the Fed's face, they're calling it transitory.
It's crazy.
And basically, the situation you're in today, what we're going to show you, and why basically our generation's screwed.
Yeah.
But we'll get to that point. Is because they're calling inflation transitory, okay? And then it's kind of stopped trending once inflation hit 8.3%, up 8.3% year over year. That's essentially when inflation was not transitory anymore.
Right.
And then it finally comes down.
Right.
So it's like, this is rule number 1 of why we should never trust the Fed when they're telling you anything about inflation. Let's go to the next slide. So what was going on while they're calling everything transitory? CPI went up 21% in this time period. So inflation since that moment is up 21% for the American people.
Yeah.
Let's go to the next slide to see like what they're actually doing while they were saying this. So while they're calling things transitory, they were flooding the system with money. So M2, which is a gauge for overall money in the economy, went up to an all-time high of up 26.8%. Okay? Just so you know, just to bring this back to that transitory chart, right? On 3/31/2021 was when they started calling things transitory. And that's when M2 is hitting an all-time high. So literally, you couldn't be more wrong.
Yeah. And they know that. You know? Like they're flooding the economy with money, is saying inflation's just gonna go away.
But we're pumping in more money.
Right.
So that's where it all started, was M2 at an all-time high. It makes absolutely no sense. And then basically M2 continued to make, it wasn't making new all-time highs. It was up 12.6% on a year-over-year basis, which is an all-time high compared to everything else, not an all-time high compared to what we did in 2020 and 2021.
Right.
So the whole time we have M2 going basically at all-time highs, and they're calling it transitory. Then it gets worse, because maybe you can say, oh, they don't control M2 directly, completely. So we'll go to the next slide. Let's go to what happened to their balance sheet, which the Fed directly controls. Okay, here's what they did while they're calling it transitory. So you can see on 6/10/2020, their balance sheet, basically how many assets they have, was at $7 trillion, 7.2 trillion. By 2022, they grew it by about $2 trillion. So they were buying, which inflates asset prices, $2 trillion by 4/13/2022. So if we go, maybe try to go back to the original chart, the transitory one, which I think is slide 2. when's the last number of when it stops being transitory? Is literally the peak of their balance sheet. So the entire time they they grew their balance sheet by $2 trillion, and they're calling things transitory.
Right.
You're
knowing
literally
full well that they're inflating asset prices.
Literally.
It's
backwards.
Backwards.
That it makes absolutely no sense.
It's just gaslighting
whatsoever. I honestly just think it's stupidity.
Yeah.
But that's basically that whole section was about, aka why we cannot trust the Fed on inflation.
Can't listen to them.
You cannot listen to them. So even though they're saying inflation done or whatever, literally just like in one ear, out the other, we're here to help you. Okay.
Yeah.
So the next kind of big thing I want to go over, it's slide 6, is basically people say, okay, when the Fed starts cutting, it means that there's a recession.
Mm-hmm.
Okay. Fair point, and that does a lot of the time happen.
Right.
They're cutting because you're in a recession, and you want to like lessen the impact of the recession and so forth. Totally fair, but that's not all the time. In 2018, that wasn't true. It was true in 2000, and 07, and 2020. Not true in 08 or in 2018. But let's just go maybe to the next slide. Okay. Here's how we gauge if we are in a recession or not. It's very simple. It's basically this quarter over quarter SAR number. All it is, it's your real GDP on a quarter over quarter basis. And in order to be in a recession, you need these numbers in this purple box to be negative for 2 quarters in a row. And that's how
technical recession.
That's a recession.
Yeah.
Okay. Now, when you look at that chart, are those bars anywhere close to being negative? No. So the light blue one is our estimate. Okay, you think we're wrong, fine. The yellow bar is consensus, so Wall Street, they're at 1.7.
Yeah.
Okay, it's still not anywhere close to 0.
No.
Okay, and then the red bar is the Fed. They're at 2.47, so above both of us.
Yeah.
Okay, essentially, you're not anywhere close to a recession.
No.
Like, could we be wrong and GDP could be down a little bit more than that? Sure.
But how much more?
You need to be down 2%. It's like that would be a monster like deceleration. It's just not where we are at all.
No.
Right? Because 2% is not negative. So it's like you're not even close to a recession.
No.
And the Fed's numbers aren't even close to a recession. So again, it's like, why and what are you doing?
Yet they're data dependent.
Yet they are data dependent.
It's just...
But we'll go to the next slide here on 2020. Here. So this is kind of like an easier way to see what's actually happening in our economy is when you get away from the quarter over quarter.
Yeah.
You look at just GDP year over year. Okay. All that's happening is we're currently at the black bar, the 3.15, and we're heading towards the blue bars and the yellow bars, which is about year over year 2%. Okay, so your economy is slowing, like that is happening. There's no doubt about it. Like economy's slowing.
Yeah.
Okay, but so that's what we've been seeing is like you're just in a slowing economy. It doesn't mean though you're in a recession.
It doesn't mean you need an 50 basis point emergency rate, like
yeah,
it definitely doesn't mean that.
It doesn't mean that, right? And so that's why I would say that this time is going to be different than 2000, 07, and so forth because you're not in a recession.
No,
you're just not, and we don't have a recession for some time. So what happens when you're not in a recession and when rates go down, all they do is spend a lot more.
Yeah.
Inflation goes
up.
So that's going to be really bad. And what's really happening is if we go to slide 9, it's called dollar devaluation. So we'll try to keep this pretty simple. So when the US dollar, right, it devalues. Basically what that means is when we go and we import things from other countries, when basically the dollar is going down, you can import less goods
for the same price.
Which really all that means is that it's basically an inflationary thing.
Yeah, you're paying more for the same amount you used to get.
Exactly. And within the last 1.5 months, our currency's worth 5% less.
That's not good.
Which is not good. So, like, when we Americans, we go on the world stage and we're trying to buy things, and maybe you're like, well, I don't like import from China. Well, the companies you're working with, they're importing from other countries and so forth. Like, almost all of our goods are imported, like, one way or another. You don't look at any product and it says made in the USA. Let's put it that way. And even if it is made in the USA, the raw materials are probably from somewhere else. Probably. So anyway, so that's what's happening is really we're devaluing our own dollar.
Yeah.
And that's going to be actually really inflationary for hard assets again.
Yeah.
And that's going to be really bad for the American people.
Yeah.
And so that's what we're actually going to focus on for the rest of this is what's actually happening.
And how it will impact you.
And how it will impact you. If we go to the next slide, just really quickly, like another way of seeing like how you devalue the dollar. Now, there's so much that goes into the dollar, but really what happens is the economy and the countries, they all look at what their current rate cuts are versus the rest of the world.
Yeah.
Okay.
Yeah.
The U.S. is one of the only countries. So if you look at just the next meeting, it doesn't say next meeting 2. It's just the first column.
Yeah.
So the U.S. we cut rates that -2 would be our number right there. Okay. Great Britain 0. Okay. You're 0. So they didn't cut.
No.
Right. So and you know what the UK was actually saying? They're like, inflation's going to go up actually for us. And so we're not going to cut rates.
Right.
So when they're not cutting rates, they're saying inflation's going to be what it is. And you have a Fed who's kind of clueless and they're cutting rates by 50 basis points while everybody else is not and saying the opposite's going to happen. Your currency, and it's basically the world's trust in your currency goes down.
Yeah.
And when the trust of your currency goes down, we, the Americans, are the ones that lose because inflation and all this other stuff is going to happen. But if you kind of look at like meeting number 5, this is next year, we have 5 rate cuts. Like Norway has 2, Australia has 2, UK has 3.5. Like by being the person on the street, like gun ho, we're going to cut rates. All that's going to continue to happen is the value of your currency is going to keep going down. It's going to go down for a good amount of time.
Yeah.
So 5% down, this isn't the end, most likely.
No.
And so that's what's happening. But we're going to cut to actually, we have something called the call for us. We're going to go to 2840. And this is Josh Steiner, one of our great colleagues, talking pretty much about what happened at the Fed and talking about dollar devaluation.
Of the shelter inflationary backdrop. Remember, being long housing is another way of saying being short the dollar. And that's really what this is all about, is the sort of reacceleration of the debasement of the dollar from a purchasing power standpoint. And, without being able to do anything on the supply side of the equation, which I don't think she'll be able to do, ultimately, we're just going to create a lot of incremental demand that ultimately, of course, won't be met on the supply side and therefore will be reflected in the rate, or rather the price element. So, yeah, I would certainly be taking the over on HPA, home price appreciation, reaccelerating significantly over the course of this coming rate cutting cycle. So that to me is one of the takeaways.
And we'll stop right there.
Yeah.
So you heard what you said, right?
Yeah.
So in a down dollar period, what happens is home prices go up.
Which is already an issue.
Which is already a massive issue.
Yeah.
So basically, if we go to this, let's just see the next slide.
Let's see the next slide.
And we'll go to slide 11, which shows this, right?
Ugh.
Basically, And like '02, you saw the dollar go down significantly, and the black line is home prices. So green line, the blue line goes down, which is the dollar, and then the black line, which is house prices, go up.
Yeah.
And this is just a tale as old as time, almost. It's like one of those natural things that happen. So if we're saying the dollar is going to keep going down, and we want to keep cutting rates, despite everything, inflation's going up, we're going to keep cutting rates, dollar goes down more, home prices go up further. So that's one of the main reasons why we are going to be pretty screwed. Me and you, because we don't own a house, unless you do. No.
Do not own a house.
Yeah, so we're going to be screwed, because essentially, if you're saying, and you're looking at home prices right now, and you're saying these are way too expensive, and they're outrageous.
Yeah.
Well, guess what? As the dollar keeps going down,
they're going to go up.
It's just going to go up even further, and a lot, and quick.
Yeah.
Too, because we're basically acting on the market. And we'll just go to this next cut over here. This is of Keith, who's also on our team, our CEO. He's a good guy. It's at 31.15.
They needed that. They wanted that. And what they get is an assurance that the affordability problem of housing in America is going to become the biggest problem since it became a problem. Yeah, that's the trade, right? We're trading the stock market and cowbell for, the people just having to sit on it and rotate. I mean, you can't say that you're hitting all-time highs and HPA or home price appreciation's going back up and saying there's no inflation. It's just stupid, right? And Americans aren't dumb enough to believe the dumb people that say that.
Yeah.
Yeah. And, the market goes up, sure, nice, but nobody can buy a house.
Right, but the market's going up, but who owns the things? Who owns the market?
The elites.
The elites, the rich.
Yeah. Yeah.
Anyone
that's not worried about inflation, basically. Like, if you have enough money, inflation is a non-factor.
It's not a factor to you. So basically, what you're about
it's actually good for you.
It's
your
amazing
assets are
for
inflating.
You. Because just look at the market today. Nvidia's up 5%.
Yeah.
Okay, so let's just say...
Once again, very cool, very cool. I don't have a house. I'll never have a house.
Right. So, and that's the problem, is they're going to make a shit ton of money off of this, because the stock market also is going to go towards all-time highs.
Yeah.
And they have 10x, 20x the amount of money we will have in the market.
Exactly.
Therefore, they're going to make millions off of this.
It goes right back to what you were saying earlier, where I was saying, oh, maybe he's just panicking, and you're like, oh, well, there's some outside influence most likely happening, because who stands to gain and who has power potentially over Powell is these same people that stand to benefit the most from higher inflation.
Yeah. And him cutting rates.
And everybody else that isn't really involved in that is getting more and more screwed.
They're going to get more screwed, because what happens first, the stock market goes up, housing prices go up, and then the lag on that is the CPI thing that they look at, right? It goes up afterwards. So after things have already gone up a lot, then the Fed sees, oh, this is going up. And then they either have to call it what it is or call it transitory. Right. If they call it transitory, it's just going to go up further.
Right. We saw that
and faster. Right. Exactly. And so, yeah, that's where we're at.
That's exactly where we're at. I mean, I'm sure everybody can see it.
Yeah.
Everybody can feel it.
Everybody can see it. Everybody can feel it. If we go to this next slide, because this is also really what's going to be really bad. So just so everybody knows, since 2020, housing prices are up 53%.
Holy.
That's national home prices. And that's home prices appreciating with rising rates.
Right.
During that time period, rates went from 2.82 up towards 6%. That's a mortgage rate.
Yeah.
What's supposed to happen is housing prices are supposed to come down during that period. But remember what was also happening. What were they? They were using the word transitory. Inflation is transitory. While everything's going to all-time highs and they're pumping the system with money. And that's why housing prices went up, even though rates were going up.
Right.
But now we have the opposite. It's almost like a launch pad. Like you're up here now, and maybe you came down a little bit, but now we're lowering rates, and now we're just gonna.
It's just going back up.
Right. It's like you're at this higher level, and it's just gonna reaccelerate, because when rates go down, that's when home prices should be going up.
Right.
Right.
But
So
now it's just all
So if house prices
up.
went up 53% while rates were going up, and they shouldn't have been, and now they're actually going to go down. Yeah.
Yeah, it's just going to skyrocket.
Yeah, it's going to be then you like basically, and if you don't own a house, your rent it's going to be the same exact thing. Rent is going to go up as well during this. It's basically any assets go up.
Yeah, and if you don't own them,
then you're eating the cost of that
Yeah.
because your wages are not going to go up in line with how quickly the prices of like a home will go up or the rent. And so you are ultimately the one that eats that.
Yeah.
No.
Yeah, it sucks. I think a lot of people our age like aren't really aware of this. I mean, you certainly can feel it, but it's the whole thing where people are saying how like, the boomers own everything and it's just kind of going to be that way. The wealth isn't trickling down the same way it used to, and they're holding on to it a lot more, and they're sitting on these massively inflating assets that are kind of becoming a burden to the younger generation.
Yeah, but here's the thing: why would they sell?
No, why would? Yeah, no, I don't.
Why would
it's not
you?
their fault.
And
right?
you have this pile. Let's just say it's like 10, 20 million all of a sudden.
Yeah,
and now Nvidia's going up 5%, or stock market today, I don't know, it's up 1.2%. Well, let's just say it goes to all time highs, and it just keeps making new all time highs.
Yeah.
All of a sudden, they're making millions of dollars just by holding on to these assets.
Yeah.
While you're not invested, you don't have the amount of money that these people have.
No.
By any stretch of the means.
No.
And so it's literally rich are going to get richer, poor are going to get poorer type of dynamic.
K-shaped economy is what we always say. This is in our last couple of macro themes decks.
Yeah. And then over the next year to two, and if we continue to cut rates like this, it's ultimately what people are going to wake up to is like, hey, that's great. You guys got this like small reprieve or whatever you want to call it on the economy. But like, hey, remember when you called it transitory, right? And all that. And like you guys had that small relief, but now the Americans, like actual Americans, can't handle this 20% inflation, right? Since 2020, since when you started that.
Right.
All of a sudden, we're just going to be in the same thing.
Yeah.
It's literally like we're like chasing.
Worse.
Only it's probably going to be worse for the people because it's all since 2020 when they started this.
Yeah.
And so it's really bad. And we'll just go to our last clip here. It's of Josh again at minute 33.
The bigger sort of themes or stories over the next, well, not story in the sense that it's made up, just something people talk about because it's relevant to basically everybody. Over the next year or two is how expensive shelter becomes, whether you're a renter or an owner. The only people excluded from that, sort of dynamic are going to be existing homeowners with low fixed rate locked-in mortgages, right? Because they're less exposed. But yeah, everybody else sort of on the front end of things who's a renter or, trying to buy for the first time is going to be, paying the price on that over the next year.
We'll stop it there.
Yeah.
We're going to be paying the price.
Yeah. Yeah. I mean, this all ties into what you can hear and feel. I mean, I just looked up real quick. It says in the past year, 59% of parents reported financially helping their adult children. Like, that's insane.
That's going to go up.
That's insane because, a lot of people just have no choice. Like you said, it's shelter. Like pretty much one thing you need besides food.
It's almost almost like a third of your daily cost, or like your cost or your paycheck is probably going towards a shelter.
Yeah, if not more.
If not more, yeah.
So it's just becoming like simply unaffordable, which is just going to become a massive issue.
If it's unaffordable now, and you're cutting rates and devaluing your dollar, it's only become more unaffordable.
Yeah.
So that's where we're heading, people.
Yeah. Yeah, it sucks that, a Fed rate cut is such a big deal. It really shouldn't be that way. But once again, they're strong-handing the economy, trying to fix things, and it's just creating massive issues.
Yeah, it really it shouldn't be. It's kind of sad that it is. It's also sad that, like, the system even exists this way.
Yeah.
Like, I mean, I think their goals and objectives are all off. Like, I think there's so much off about it.
Yeah.
That, like, I don't know. It just doesn't make sense.
It's annoying. You know, it's annoying. It's like, come on, like, this
Well,
is getting to be a lot.
Well, yeah. Well, I mean, that's why the biggest joke is every single meeting when he starts with "I'm here for the American people." It's like, which American people? Are you here for the
10 or the 10 million?
Exactly.
You know? Like what?
And the 10 are all the rich, which
They
is who he
control
just pandered to in this most recent rate cut.
I know. It's
so
like you've been saying this whole time. It's shockingly obvious what's going on.
Yeah. Yep.
And it's really gonna have a huge effect on a lot of people, especially young people, just trying to, you know, come into the workforce and
try to get out of your parents' house.
Right. Like it's just so many hurdles.
There's going to be a lot more.
Yeah.
So we'll keep you guys posted on it. Obviously, that's why we're here. We're here to tell you exactly what is going on and how it's going to affect you. And we're just going to keep telling you what's going on and how it's affecting you. We'll give you the honest truth because, well, honest truth, while it does hurt, hopefully you can better yourself a little bit. All right. Good luck out there.